Now, most investors hit a wall when you go above 4 units. Traditional lenders call it commercial, and suddenly you're looking at underwriting guidelines that are a lot more strict, that require a lot more information and resources from you, and you kind of move away from the simplicity of the single family DSCR underwriting process. Now, what if you could buy a 5 to 10 unit multifamily building using DSCR underwriting that is simple and easy to qualify for, similar to single family DSCR underwriting? Now, that's what today's video is all about. It's about a DSCR loan product for a 5 to 10 unit multifamily dwelling. Now, here's why this specific niche matters. So most investors that have purchased anywhere from 1 to 4 units understand how easy and simple that underwriting process is, as long as your criteria for the deal meets the criteria for a single family home. For the most part, going up to 4 units, easy. Now, when you get above 10 units, what happens is a lot of lenders will look at this and they're going to look at the overall loan amount, the purchase price. And if it's below $3 million, they're not really going to want to touch it. They're not able to get the commissions that they can normally get, and it's just not in their stock of loan products that they offer. So we have this little sweet spot here between 5 units and 10 units, where there's a lot of demand out there nationwide, and there is a loan product, several loan products actually, that fit this exact need. Now, this is where specialized DSCR products like this one fit in. So here's how DSCR products work for 5 to 10 units. Now, just like residential DSCR loans, you've heard me say it a million times, this is going to be based primarily on the property's ability to generate cash flow, not your personal tax returns, your pay stubs, or 12 or 24 months of bank statements. So the lender calculates the DSCR ratio based on the appraisal, and they're going to measure that, or actual rents, against what your actual mortgage is going to be every month, including taxes and insurance. And if you cash flow, then you're going to be in a good spot. There's a couple caveats and I'll get to those. So if the property pays for itself, you're likely approved. No big deal. So I'll walk through a few of the eligibility requirements for these. So first thing first is credit for your borrower profile and experience. So with credit, you're going to want to be higher than a 680 on your FICO score. That's important. And then second, for your borrower experience, you're going to want to have a primary home yourself for at least 1 year. Okay. And some lenders vary, and these products, I'm pulling information from a few different lenders that have this product, okay? So keep this in mind. But some of those lenders also want to see experience with holding multifamily rental income properties, or even a single family rental property that you've owned for at least a year. A lot of the experience is gauged over the past 12 months. Some lenders like to see the experience gauged over the course of 2 or 3 years. You're going to want to be careful on the acreage, right? The size of the lot this property's on. A lot of lenders don't want to see more than 2 to 5 acres. And the property must be held in an LLC, which speaks to borrower profile. So you have to have an active LLC in good standing. You cannot use a primary residence as your experience for your rental property. So you have to have primary separate, and then you have to have a rental property separate as well. Now, for the loan amount and terms, you're typically going to be able to borrow anywhere from about $400,000 up to $2 or $3 million on the purchase price. Okay. And then the terms for these loan products, you're going to see these similar terms elsewhere. So 30-year fixed is going to be pretty ubiquitous. You're going to see that with a lot of offerings. You're also going to have interest-only loans. And in some cases, the interest-only loans, they're going to have lower payments, but also you're not paying down any principal. So keep an eye out for that. Make sure that the loan product offering fits your underwriting. Now, for the interest-only product, the first 10 years is going to be interest-only. After that, the product is going to amortize into a long-term 30-year loan. Now, for purchase and rate and term LTV limits, okay, this is how much the bank is going to lend you as a percentage of the purchase price, or on the rate and term refinance. This is going to be 75%, okay? Now, for cash out refinances, you'll find the lenders can go up to 70% for up to 9 units, 5 to 9 units. When you go to 10 units, you'll find that they're only able to give up to 65% of the value on a cash out. So make sure to keep this in mind for your underwriting. If you're going to get a fix and flip loan, for example, get into a property, fix and flip it, start getting it tenanted, which is an important variable I'll get to shortly. You might only get up to 65% on cash out. So you got to make sure your numbers work, not just on the fix and flip, but knowing what your exit is you want to make sure you're not leaving a whole lot of money in the deal. So make sure that underwriting fits for your after repair value. And remember, you're getting underwritten on the property's ability to generate cash flow. So the cash flow is always key. Pricing gets much sharper the lower the loan amount that you're borrowing. If you hit that maximum, you're going to get one set of fees and costs and rate, right? But if you're borrowing less, that rate oftentimes improves. Now for the ratios, what are we looking at for ratios here? Well, 1.0 is sort of the standard for single family, even up to 4 units. 5 to 9 units, 1.00 ratio is still the gold standard. In some cases, if you have 9 units or 10 units, that ratio is bumped up a little higher, okay? So from 1.0, you might go up to 1.25 on the ratio requirement for 9 to 10 units. You just need stronger cash flow. A lot of lenders also have a vacancy allowance here, okay? Now this speaks to tenancy. So some cases you might find yourself fix and flip loan. Let's go back to that example. You fix and flip a property, a multifamily, you get it all squared away and all finished. You're gonna need to start getting tenants in there right away. So some of them offer a 20% vacancy allowance, which means if you have 7, 8, 9 units, you're gonna need to have all those units filled, maybe with the exception of 1 unit. You might only be able to have 1 unit vacant when you apply and get approved for a DSCR rate and term or cash out refinance. Now, this gives the lender a cushion. Now it also means that your rent matters, okay? So make sure that you have a solid exit getting these properties tenanted quickly so that you can get through to final approval on your DSCR refinance. Now for ownership structure, they do want to see LLC ownership here. So make sure you've vested in that entity when you start the refinance process. Likely you've already closed in an LLC if you're going through a refinance. At minimum for reserves, you're going to need 6 months of reserves. This is 6 months of monthly payments on hand. This could be checking account, savings account, could be retirement accounts, any sources of reserves that you have to show. You don't need to use them for the loan, but you need to have them available, and we need to show those statements to show that you're good. In case there's vacancies, in case there's any adverse events in the future, you've got money on hand to make those payments. The lender wants to see this information. And one important note here, oftentimes these cash out proceeds cannot be used for those reserves. So they have to be separate from the cash out proceeds that you're getting at closing. Now for prepayment penalties, you're going to want to have this in mind. You want to know how long you're going to hold this property. Hopefully you're going to hold it for forever and a day. The shorter the prepayment penalty term, the more expensive the rate's going to be. If you wanted a 1-year prepayment penalty, that's going to cost more in the rate than if you went with, say, a 5-year prepayment penalty. The 5-year prepayment is going to offer the best rate. Most of the time, a 3-year or a 5-year prepayment is pretty standard and what most investors seek, especially if you're planning to hold. There might be a refinance down the road as rents increase and you want to pull out more of that equity to use for other investments or to improve this specific property. And also appreciation is a factor. You might want to pull more cash out when that happens. So overall, the big picture here is DSCR products are a fantastic fit for investors, whether it's 1 unit, 3 units, 5 units, even up to 10 units. This specific niche product fits that gap between small multifamily units and getting into those larger multifamily properties. And for people out there looking to build a large portfolio that have a lot of private money partners or equity partners, and you're just seeking out these opportunities, this could be a fantastic fit for the next project. For portfolio builders, this type of loan product could be an amazing game changer for your business without sacrificing leverage or flexibility. And you can scale from 4 units up to 10 units quickly and simply with this type of loan product. So if you've been seeking some of these larger multifamily deals above 4 units where less investors play in this sandbox, that's certain. These opportunities exist. You're going to find these opportunities out there once you start looking for them. And this is a fantastic fit for those sorts of deals. So if you're ready to buy or refinance a 5 to 10 unit multifamily using DSCR loan products, I'd love to chat with you. Let's run through your scenario. Schedule a quick strategy call in the Calendly link below. I'd be happy to walk through your options and give you a second set of eyes on your deal. So if this video helped clarify a few things, definitely hit the like button. I appreciate you being here, and also subscribe. My goal is to keep bringing out more mortgage insights for you, the investor, as well as helping empower realtors with this information, and helping homeowners discover how investments work and how the financing works for investments to help you create wealth, both for yourself and for generations to come. Really appreciate you tuning in. Thanks so much for watching the video. Hope you enjoyed it, and we'll see you in the next one.